Aggregate demand. When we think about aggregate demand, recall the components of GDP that we learned about in earlier lectures. Y, output, is composed of four different elements. The first is consumption. The second is investment. The third is government spending. And the fourth is net exports, that is exports minus imports. And these components, the components on the right-hand side of our equation, are the things that influence aggregate demand. So when we graph an aggregate demand curve, on the horizontal axis we have output, or GDP, and on the vertical axis we have the price level. So as what the aggregate demand curve says is how much do people wish to consume, invest, how much do governments want to spend, and how much on average do we wish to export at different levels of prices. And what a downward sloping curve says is that at lower prices, GDP, the desired level of spending will be higher. The desired level of consumption in the economy will be higher. The desired level of GDP will be higher. Why does the aggregate demand curve slope down? It's important to recognize that this is not for the same reason that demand curves slope down in individual markets. The first thing to recognize is that when we think about aggregate demand, the amount we want to consume depends also on how much we want to work and how much we want to exert effort. But why does aggregate demand slope down? Typically, there are three reasons that economists point to. The first one is what's known as the wealth effect. That is, we have money holdings in our wallets and in our bank accounts, and when prices fall, the real value of our money balances, the real value of our wealth increases. So when prices fall, the value of my bank account in real terms is increasing. Secondly, the interest rate effect. When prices fall, this leads to an increase in the supply of funds for investment. When prices fall, I don't care to carry as much money in my bank account, and so I can make more funds available for investment. This reduces interest rates and increases the amount of investment that happens in an economy. And then thirdly, the exchange rate effect. When prices fall, U.S. goods look relatively cheaper to foreigners, and so foreigners want to buy more of our products relative to the rest of the world. And so this leads to an increase in aggregate demand through the net exports term. A change in prices can induce a movement along an aggregate demand curve. That's the first thing to recognize, that when prices change, we get a movement along the curve. So if the only shock to the economy is a fall in prices, what we get is an increase in aggregate demand due to the wealth effect, the interest rate effect, and the exchange rate effect. A number of things can induce a shift in the aggregate demand curve. The first thing is to recognize that whenever consumption, investment, government spending, or net exports changes, we get a shift in the curve. Whenever consumers desire to consume more or businesses desire to invest more, we get a shift in aggregate demand. If we might see, for instance, an increase in consumer confidence or an increase in in business confidence, we might see that the desired level of consumption for consumers rises or the desired level of investment rises. Whenever we see changes in the components of GDP, the desired level of each of these elements, we see an increase in aggregate demand. The second thing to note is that changes in the money supply can induce a shift in the aggregate demand curve. If we increase the money supply, this makes more funds available and can lead to an increase in investment. So what kinds of things increase aggregate demand? We mentioned that consumption, that increases in desired levels of consumption increase aggregate demand. So when we think of, for instance, higher consumer confidence, consumers think that the economy is going to be growing and incomes are going to be rising, they increase their desired level of consumption. This leads to an increase in aggregate demand. Lower tax rates can have the same effect. If my tax bill is going to be lower, I can consume more, and this can lead to higher levels of consumption and thus higher levels of aggregate demand. On the investment side, if I have better investment opportunities due to technological progress or more confidence in the business environment, more confidence in the economy, this can lead to higher investment and higher aggregate demand through that channel. Lower taxes on business investments can also lead to increases in aggregate demand. And again, as mentioned before, an increase in the money supply can work through interest rates to increase the desired level of investment. Increases in government spending directly move the aggregate demand curve to the right. And then net exports might increase for a couple of reasons. The first one is if foreign economies are strong, they might have more money to buy more of our goods, to buy more U.S. exports. And also a weak domestic currency, that is when the dollar is not worth very much, we can get an increase in aggregate demand here. Consumers can purchase a lot of dollars. Foreign consumers can purchase a lot of dollars through the exchange markets and increase aggregate demand here to buy more of our products.